Hello, everyone, and welcome to our special elections and markets event. I'm Angela Palacios, partner and director of investments here at the center. I'd like to thank everyone for joining us today. But before we dive into the presentation, I'd like to note that this webinar is not open for questions in real time. However, if you do have questions, I'll put my contact information up on the last screen so that you have that if you would like to reach out to me afterwards. We are lucky to be joined today by a member of Vanguard's team of portfolio specialists, Liz Muirhead. I'm sure you have all heard of Vanguard, but in case you haven't, Vanguard is one of the world's largest investment companies with a rich history spanning nearly 5 decades, even longer than our nearly 40-year history here at the center. Over the years, Vanguard has been a great partner of ours. They have consistently championed investor ownership, balance, and the long-term perspective. Liz is a senior portfolio specialist for Vanguard and has spent her 27-year career there. She's held a variety of roles, most notable as Senior Investment Director, responsible for search, selection, and oversight of Vanguard's fund range, including their sub-advised mandates. She also spends some of her time working with people like me on investment thought leadership topics, investment solutions, and portfolio construction. Liz is also a CFA charter holder. So join me in welcoming her today. You'll hear from her in a few minutes.
Thanks very much.
No doubt you are all interested in hearing some historical perspectives on the interplay of governments and the US stock market and economy from Liz. But before that, I'm going to do just a quick update on markets this year, as well as what might be happening with interest rates for the balance of the year. I'll also give a brief perspective on the election as I see it before I hand things over to Liz. So this year has been off to a very strong start. Mega cap US tech stocks have remained a standout this year again and have driven much of the returns of the S&P 500. Bonds have been positive by about the interest they've paid so far this year. But what's really been driving returns so far this year? It's been really interest rate expectations that have been the major drivers of market returns so far this year. You may have noticed that I left the election out of this list. And it's because we really haven't seen volatility surrounding the election this year. Even though election cycles are unpredictable, as we've seen with Biden stepping out of the race and Harris stepping up, and an assassination attempt on a candidate, the markets really haven't been surprised by anything yet. While elections can drive headlines, short-term volatility, certainly, and of course our emotions, markets are driven far more by factors like economic growth, Federal Reserve directions, and fundamentals like growth and valuations. So speaking of the Federal Reserve, interest rates are on all of our minds. US money market futures if you look at like the 3-month overnight lending rate, serve as a good gauge of market expectations about the future path of the Fed funds rate. In this graph, the futures contract was pricing in 3 or 4 25 basis point rate cuts by the end of 2024. Back in October 2023. So if you look at it almost a year ago. In December of 2023, that same contract priced in 6 or 7 rate cuts by the end of 2024, and then reverted all the way back to 1 rate cut at the end of April 2024. So you can see how much sentiment can swing for rate cuts in a short amount of time. Now we're fluctuating around 2 or 3 rate cuts expected by the year end, more than likely 2. This has driven really the bond market performance this year, which was slightly negative in the first quarter of the year because of that downward adjustment in rate cut expectations you see in the chart here, but then turning positive again since then. So not only has this driven bond market returns, this fluctuation in the rate change sentiment, but more so it's driven stock market returns. When markets would get a discouraging inflation reading, investors would lower their expectations for interest rate cuts and markets would contract, and vice versa. But it's becoming clear that this higher rate environment we're in is starting to hamper economic activity and indeed slowing things down a little bit. The labor market's starting to slow down a bit as unemployment is starting to creep up, and we're hearing a little bit more about layoffs. I know we've been hearing about that in the Detroit area. Consumer spending is starting to exhaust a bit too, and we're starting to see this in incentives that retailers are offering, trying to drive sales. You see this in a variety of ways, like incentives at the dealership when you're buying a vehicle, or clever value meals at fast food restaurants, or even it shows up in Starbucks offering their pumpkin spice latte at the earliest date ever, around August 20th this year. Anything to try to drive consumers into the stores. So let's turn our discussions to the candidates. Each candidate has their own unique areas of focus, a few being listed here. As for who we think will win, it's too close to call, and we are still weeks away from the election, and that's a lifetime in politics these days. Plus, we know the Electoral College and the popular vote can be two different stories when it comes to Election Day. I would like to take a few minutes to outline some of the differences on major topics between the two candidates, though. First up, and maybe top of many of our minds, I know it's certainly top of our mind, are taxes. The big issue really is the Tax Cut and Jobs Act of 2017. When it passed, there were many provisions that were set to sunset at the end of 2025. Corporate income tax cuts were permanent, but individual tax returns are in flux, as well as estate planning and the SALT deductions, so state tax deductions. It's likely if the Republican wins, we will see all of these extended. Under a Democratic sweep, we'd likely see individual tax rates for those top payers, those top tax rate payers, increase probably from 37 to 39.6%. The estate tax exemption amount could drop back down to around 7 million from 14 million for couples. A corporate tax rate increase could be back on the table as well. Speaking of trade, this is an area where the president actually has a lot of say. Congress has conceded much power historically to the president to set policy here. But both parties seem to be willing to set tariffs, but the issue is they tend to hurt supply chains, slow the global economy, causing inflation and supply chain disruptions. But both parties are basically on the same page here. Immigration, likely to be a little more aggressive restrictions or at least enforcement under a Republican presidency. They have to be careful though, because too much restriction restricts that labor pool, and both parties know this. Energy, no surprise here. Republicans are more pro fossil fuel. Democrats would be more focused on the clean energy transition. Healthcare, no one's really messing with Obamacare at this stage, but Vice President Harris has indicated she will continue to work focusing on lowering prescription drug prices. Monetary policy, under Trump, he did browbeat the Fed before, and this would likely still be the case. But there isn't much either of them can do here. The Federal Reserve is kind of on a path that they set themselves. And those are just some of our thoughts on how our policy could be affected. It does depend how much of a majority each party has in the House and the Senate. If the election result is gridlock, meaning different parties in control for the presidency, the House, the Senate, little change is expected. However, if there is a red wave or a blue wave, then we could expect some changes that might affect one sector or another a little bit more. The Senate battle is actually looking very interesting right now, as it looks to be a toss-up. on a few seats that will be responsible for likely a slim majority one. There are 3 Democratic seats that are looking a bit like a toss-up, and one of those is here in Michigan. Now, when it comes to sectors that could be winners or losers based on an election outcome, that can be less clear. The economy is usually the guiding force long term behind winners and losers. A seemingly obvious outcome could be energy, for example. Under a Harris administration, you might expect clean energy companies to perform better, while under a Trump administration, more traditional energy might be expected to do better. However, when you look at the past Trump and Biden administrations and how energy companies performed under both, the opposite actually occurred, where clean energy performed better under President Trump and traditional energy performed better under President Biden. If you're interested in seeing a chart on this, reach out to me. It's certainly an interesting one. Overall, rising corporate profits, continued economic expansion, and the potential for lower yields later in the year and next year provide a positive backdrop for markets in our view. We expect this environment to be supportive for both stocks and bonds. Now I'd actually like to turn it over to our guest speaker, Liz, to review more information on elections and the impact that they may have on us in markets.
Wonderful. Thank you very much. I'm going to take a moment to get my presentation up as well. Okay. Well, thank you very much. It's a pleasure to be with you today. And I'm going to provide some research that Vanguard has done to just put a little bit more of a long-term historical perspective on the intersection between investing and politics, in particular, presidential election cycles. This is one of the hottest topics we've heard from advisors and their clients this year. Many clients are concerned about what the implications are for their investment portfolio of the contentious election and should they be making any changes. So I'm hoping to provide you with some context that will help perhaps put some of that anxiety at ease. So let's start with first this very long-term perspective. I think one of the big questions that we hear from clients is, should I go to cash ahead of the election? Should I be worried about how the election might affect my stock market returns? And, I think first it's important to say, how much cash do you need? Cash is for short-term obligations, what you need over the next 6 months to 2 years, depending on your level of risk, should be in cash. But most of your assets are likely for long-term growth. They might be for retirement. They might be for your children's future education. Generally, even people in retirement have at least a 5-year time horizon. And that gives you an opportunity to ride out some of the bumps along the road. When we looked historically, you can see, the red areas being areas where the Republicans were holding the presidency, and blue areas were areas where Democrats were holding the presidency. The stock market tends to grow no matter who's in power. The line is upwardly sloping to the right, and even through all of these transitions, the ups and downs that we tend to see in the stock market are very much not related to elections, but are related to other types of drivers of the market. So we can look at things like in the early 2000s, the bursting of the tech bubble, or close to the end of 2008, the global financial crisis. Those were issues that they both caused blips on these, but they really had very little to do with who was in power. We do recognize that public policy, as Angela just reviewed, can be consequential in terms of what comes out of that presidency. We still see the same pattern of investment returns continuing regardless of which party is in power. And so I think this is a really good proof point to help you stay focused for the long-term part of your portfolio on the investment plan in order to give you the best chance of investment success. At Vanguard, we call that staying the course, because if you know Vanguard, you know we have this nautical theme that is pervasive in everything we do. But really just sticking to your plan and trusting your advisor is a really important message to keep in mind. Now, I do think it's important to take a step back and say, okay, that's the stock market. Let's look at a more traditional balanced portfolio. That's a portfolio that's typically 60% stocks, 40% bonds. It's often used as kind of the broad benchmark for what a typical client in retirement might have in their portfolio. And you can see that this 60-40 portfolio on a year-to-year basis is actually positive almost all of the time. You can see on the left-hand side of the slide, there are a few years here and there where that portfolio has had a net negative return. And you can see it coincides with some pretty big historical events you might recall. You can see in the more recent history, you can see, the decline from 2022 standing out in terms of that rate hike cycle. You can see 2008, the global financial crisis, and the bursting of the tech bubble and some of the issues with Enron and WorldCom falling in that 2000-2001 era. And so those are, kind of important historical milestones that don't, again, correlate to any particular presidency. When you take these over a 4-year period and you take each presidency in isolation, it looks even more positive. And remember, as I talked about before, your long-term assets have at least a 5-year time horizon. So that's going to take you through one presidency and into the next cycle. And you can see, with the exception of, the 1940 to 1944 time period, you actually had a positive 4-year return in a balanced portfolio from every single presidential cycle that existed from that point forward. And I think that's very reassuring as well. It didn't matter whether it was a Democrat or a Republican in power. And even some of those exogenous events that occurred in the early 2000s and 2008, when coupled with the years around that, did not actually lead to a negative return over the entire presidential cycle. So again, very reassuring to see in historical context. Now, I do think there is a lot of volatility in the market right now, but there are a lot of things that contribute to volatility. And so when we look at the volatility from an election year, we asked ourselves, do we think that the volatility seems to spike or escalate in an election year relative to a non-election year? And you can certainly see that a non-election year, which are the yellow bubbles here, tend to concentrate in a less volatile range. We do tend to see some higher lows and and some higher highs and lower lows in an election year, particularly in this time period that we're in right now. The months leading up to and the months just after an election, we do see more volatility. However, just because something is volatile doesn't mean it's negative. So in this case, you can see anything in the top half of the chart is what we might describe as positive volatility. These are, a daily return of the S&P 500 that was in excess of 1 or 2%. There's also some green dots in the bottom half where there was a negative daily return of the S&P 500 of 1 to 2%. So even though there's a higher level of volatility, sometimes that volatility is positive. When we look through the entire 4-month window, both election and non-election years were positive on average. So we will likely see a little bit more volatility, but remember, volatility doesn't necessarily mean that your portfolio loses value. And just zooming out and giving you a little bit more context over a longer period of time, we often find when we analyze daily performance of the S&P 500 that the biggest up days come in very close proximity to the biggest down days. So if you see a really big down day, like we saw a couple weeks ago in August, and you say, "Oh, I'm spooked, I'm going to sell to cash," you miss the recovery. That recovery back in August actually took 5 days to get right back to where we were at the beginning of that week. And yet somebody who sold out to cash missed the recovery. So they locked in their loss and they missed the bounce back. Timing the market is really challenging. If you have a long-term time horizon, it's better to just stick to your plan, tune out the noise, listen to your advisor, and know that this 4-month volatility period that we might experience usually ends in a positive return. Most of the presidential election years also end up positive, and certainly almost every single presidential election series that we've seen, 4-year cycle in the balanced portfolio, has been positive since 1944. Now, one of the things that Angela talked about, was the idea of how the party shakes out in terms of not just who has the presidency, but also who has Congress. And that plays another important role when you think about the outcomes. So when you're thinking about what happens, maybe there's a particular outcome that you're very concerned about, and you might say, you know what, I'm just too nervous. I want to go to cash. Cash rates look pretty decent right now. I'm really nervous. I'm just going to lock in that, what I have right now and go to clip my little 5% coupon. The problem is when we look historically, staying in cash during an election year has typically resulted in a worse return. And there are a few exceptions to that. But again, it often leads to a worse return. The other thing that I will point out is that we are poised, as Angela said, for the Fed to cut rates. So those short-term cash rates that we see right now, 5% maybe here today, it is going to be gone in just a few weeks. And so remember, when you see a cash rate, you have to hold that for an entire year to earn that 5%. If those rates drop to 4% to 3%, you're not going to be able to earn that 5% on that cash. And now you've given up the opportunity to recover. When we look historically, the S&P 500 outperformed cash by more than 6% annually over the last 13 presidential election years. If you're in a balanced portfolio where you have cash and stocks and bonds, then you're typically going to see an even more positive skew there. So again, getting to this idea that there's not just red and blue years, there's also purple years. So what do we mean by that? The presidential election is not actually creating a binary outcome like we so often think about. This is not just Trump as a victor or Harris as a victor. There's a really important implication to the policymaking power that each party, each president has based on the makeup of Congress. So I'm going to pose to you, there are actually 4 possible outcomes for this presidential election. So when you start to think about things as maybe 4 possible outcomes instead of just 2 binary outcomes, you start to, I think, feel a little bit more reassured. So what do I mean by this? You have, the first outcome is Trump could win the presidency and could have a mandate from Congress with a Republican-led Congress. Second possible option is Trump wins the presidency, but there is a Democratic or divided Congress, which gives the Democrats some power to push back against the Trump agenda. On the other side of the ledger, you could have a Harris presidency, but Republicans maintain control of Congress, or there's divided leadership of Congress, which makes it more difficult for Harris to get her agenda through. Or you could have a Harris presidency with a Democratic Congress, which gives her more of a mandate. As we've seen, even those mandates are not easy to execute on. The margin of victory in Congress can give a lot of power to those more moderate individuals in Congress who might say, I don't want my party to take an extreme position. I'm going to push them towards the middle. So when you end up with a a purple outcome, that means there's a lot more compromise. It slows down policy making, and it means there's generally going to be fewer significant changes happening. One of the ways that we've tried to measure this is we've tried to look at how many bills were enacted during the term under each type of government, Democrat, Republican, or mixed, and then also what was the return of the S&P 500 index over that period of time. And so you can see the height of the bar is telling you how many bills were actually passed by that administration. And you can see that although there are some exceptions, in general, the purple bars tend to be lower than the bars around them. So you can see through the 70s and 80s, we had fewer bills passed when there was divided government than we did when there were the democratically led president and Congress right around them. And then as we headed into the more recent time period again, we saw fewer bills enacted by a Republican-led presidency and Congress, but we did see that dip even lower when it was a divided government. And so we see that trend going through this time period. We also see a general decline in the number of bills passed as we've seen more kind of policy stallouts in the more recent time periods. But then we've overlaid this with what actually did the S&P 500 do during that term. And you can see that there's really not any sort of correlation between how many bills were passed and what the strength of returns were. You can see years where there were very few bills passed and there were high positive returns, and there were other years where there were a higher number of bills passed and high returns. And so when we looked at this, we see actually no correlation. Politics has no impact. Sure, tax policy, fiscal spending, and regulatory changes have very broad implications for the US economy, but they are much smaller pieces of a larger financial puzzle that's going to also be affected by company specifics, by investor sentiment. There's so many other implications there that policy alone is not the driver of returns. And so what can we conclude from this? First of all, I think coming away with the idea that there's generally going to be fewer bills passed when there's divided government. There has to be more negotiation. And in general, that probably is good to slow things down a little bit and make sure that there's more calculated decision-making happening. But in terms of your investment returns, there's not a difference. There's not a correlation between those two things. And so I think it's quite reassuring when we look at the broader perspective that although policies may change under different administrations, the returns generally are not affected by that. So in conclusion, I know that all of that is meant to reassure you and help you stick to your plan. But what if that's still difficult for you? And what if you either went to cash earlier or you've gotten some money that you've been waiting to put to work and you've said, I want to put this money to work, but I'm afraid of putting it in on the wrong day. I'm afraid of waiting until after the election, but I'm afraid to invest before the election. We know that the sooner you invest, the better your returns will be. That's just the law of mathematics. So being fully invested gives you better, higher average returns, but we recognize that might be difficult for you to do. So what do we suggest? We suggest start now. Dollar cost averaging is a strategy you can start today, where you take all of the money that you have to put to work and you divide them into equal pieces. And you might say, I'm going to put this money to work and I'm going to get it all invested by the end of the year. Or you might say, I'm going to put this money to work. I'm going to get it all invested over the next 6 months. Or you might say, I'm going to get it all invested over the next 12 months, right? However you decide to do it, and some of that might depend on what that money's in right now. Is it in, liquid cash, or is it in, CDs that are maturing at particular points? But dividing that up into increments and then being really disciplined. So if you're creating a 6-month plan, divide it into 6 chunks and put one chunk to work every month, no matter what the market does. Tune out the noise, and you're going to get, on average, a better return than if you waited longer and invested it after the election or at the end of whatever period you're dollar cost averaging over. And so we show you here on the slide, if you put all the money to work right at the beginning, you typically get better returns. But if you put it to work over 6 months, you get almost the same return with a little less volatility, and you get that ability to sleep at night. If you need to spread it out over a longer period of time, 12 months, generally, again, that's going to lead to slightly diminished returns, but much less volatility. And again, if that helps you sleep at night, that's going to be much better for you than waiting and not putting that money to work and missing out on some of the best days of the market. When we look over the long term, just missing out on the 30 best days in a year can cut your return historically in half. So it's really important to put that money to work and to start now. And if dollar cost averaging can help you develop a plan that does that, it is absolutely the right thing to do. So with that, that concludes my remarks, and I am going to kick it back to Angela.
Thank you so much, Liz. This is all very helpful information. I'm going to reshare my screen because, as always, I like to circle back and distill this information down into what you should be thinking about for your portfolio. We determined, that long-term election volatility doesn't stick around and isn't always negative, as Liz stated. So there are some important things that we need to focus on, as always. First and foremost is your cash balances. I mean, we need to talk about this. We want to make sure that you have 6 to 12 months of expenses set aside so you can weather any short-term volatility in markets, especially if you're retired and drawing on your portfolio for a paycheck. That's really crucial. Right now, we have the opposite worry for some. Actually, cash balances are much higher than they've ever been because interest rates have been extremely attractive. But when volatility settles and interest rates start to come down a bit, markets can run up quickly, as Liz said. Missing out on those best days can really detract from your long-term performance. So that when markets are running up, that can cause investors to feel left behind, especially if that money that was in cash was really meant to be invested for the long term. Talking about dollar cost averaging, Liz talked a lot about this. It's a great place to start. And it's something we are happy to discuss with you in your individual situation. But that is a great place to kind of get started off the sidelines. Beyond cash, there are sorts of all-weather items to be thinking about. Diversification, making sure you have the right asset allocation in place. And then it's really monitoring the details of your portfolio, things like rebalancing, tax loss harvesting, or even gain harvesting if we think we're going to be in a different tax environment a couple of years from now. Being mindful of investment expenses and reviewing your holdings and determining if they're the right holdings to help you meet your goals when you're looking at the markets and the economy as a whole. So we are here to help you with all of those details so you don't have to sweat them alone. As promised earlier, here is my contact information. Please don't hesitate to reach out to me if you have any questions. If you found today's session valuable, please consider passing the replay that will be shared with you and posted on our website along to any friends or family who might benefit from this information as well. We'd love the opportunity to share our knowledge with those close to you. So thank you for taking time to listen today, and thank you so much to our special guest, Liz, for joining us.
It was my pleasure. Thank you for having me.
Thank you.